Can interest rate changes impact inflation's aggregate demand? Have you ever wondered how interest rates affect the prices of everyday goods? The relationship between interest rates and inflation is fascinating and important. Let's break it down together. Interest rates play a significant role in shaping aggregate demand, which is the total demand for goods and services in an economy. When interest rates change, they directly influence how much consumers and businesses are willing to spend. When interest rates rise, borrowing money becomes more costly. This discourages people from taking out loans for big purchases like homes and cars. Businesses also tend to cut back on spending for new equipment or expansion. As a result, overall spending in the economy decreases. This shift in aggregate demand can lead to lower inflation rates since less money is chasing the same amount of goods and services. On the flip side, when interest rates fall, borrowing becomes cheaper. This encourages consumers to take out loans and spend more. Businesses are also more likely to invest in new projects. This increase in spending raises aggregate demand, which can put upward pressure on prices and potentially lead to higher inflation. The mechanism is quite simple. Lower interest rates make loans more attractive, while saving money becomes less appealing. As households and businesses spend more, demand can exceed the economy's ability to supply goods and services. This initial surge in demand often results in higher prices. It is important to note that there is usually a delay between changes in interest rates and their full effect on aggregate demand and inflation. This lag can be anywhere from 1 to 2 years. Households and businesses need time to adjust their spending habits and investment decisions after interest rates change. Inflation expectations also play a role in this dynamic. If people believe that prices will rise in the future, they may ask for higher wages. This can create a cycle that further drives inflation. Central banks often adjust interest rates as a tool to manage these expectations and stabilize inflation rates. In summary, changes in interest rates can significantly impact inflation through their effect on aggregate demand. Higher interest rates tend to reduce demand and inflationary pressure, while lower rates can increase demand and raise inflation. Understanding this relationship is essential for grasping how monetary policy works in managing the economy.